part of what this series, Money Revealed, is about, is protecting your money. And I can tell you, there's one big giant out there who's after your money, and it's called the IRS. We might think that, well, all accounting, all CPAs, it's all kind of the same, but we can find out that there are tax strategies that can be applied that can save thousands and thousands and thousands of dollars. And if you project that over a lifetime, that makes a big difference. So I had a very interesting conversation around varying tax strategies with Jeff Socha. Enjoy this interview. Jeff, thanks so much for doing this. We have had conversations before, but haven't met face-to-face before, so I was excited to have this interaction.
Glad to be here.
So just before the camera started to roll, you said, for those of you who are making a lot of money, I'm about to make you some more.
Yeah.
You are a tax expert.
Right.
So tell us about your background and how you got into this business.
My background probably starts with growing up in a family-owned business. My grandfather started a construction company back in 1950. And so growing up in a household where my dad was, an entrepreneur running a family business, I just heard this complaint over and over around taxes. And, surely the really wealthy people, the really successful people don't have to pay all their taxes, or they find a way to reduce their taxes. And he always felt like he didn't have that help. Mm-hmm. And so a number of years ago, about 9 years ago, I got into financial services and realized I want to solve that problem and see if it's possible to help, your local successful business entrepreneur, not pay so much in taxes. And so I signed up with a couple different political action committees to lobby U.S. Congress on tax legislation. Mm-hmm. So serving as a lobbyist part-time for 5 years for both of those PACs gave me a unique exposure to tax legislation. So through that process, I also had to do a lot of just research on my own to try and find tax strategies. And what I found was that there was a lot of really high-level strategies for people that were, at the very top of, billionaires in the U.S., right? And I thought to myself, well, I don't really know many billionaires, so how can I take some of this and apply it to your successful millionaire, right? That is really getting hammered by taxes. And so that just kind of has been a, incremental process of building those strategies and then putting them in place, deploying them for these entrepreneurs that we work for.
And so is your firm, is it a tax accounting firm? Is that kind of like the focus of your business, or you consult with accountants, or what's your approach?
Yeah, that's a good question. So we don't do the compliance work. Mm-hmm. So the compliance work being, making sure that the right numbers are on the right blanks, on the right forms, and there's value to that, and it's important. We just don't do that piece.
So your strategy, basically.
We focus on the strategy, and, oftentimes people go to their accountant looking for strategy, but because they've procrastinated, and the CPAs may be in a seasonal workload where they can't take the time to focus on consulting for planning ahead, we come in and we're looking at what are the things that you're not doing that if you started doing, or what are the things not present in your life that if we added to your life would make a positive impact.
Yeah, what I'm excited about personally is that we're taking a look at my stuff and going retroactive and saying, wow, there's some advantages I didn't get that I could have, and we're gonna put a smile on my face.
Right.
But so my own experience. So this is near and dear to my heart because it's the same kind of thing. I think like a lot of people who work really hard and are business owners and entrepreneurs and take a lot of risk and work weekends and work holidays and all that kind of stuff. Mm-hmm. We are not fans of taxes. I was going to say we hate taxes, but when you say, but we're just don't like.
It's not your favorite bill.
It's just not my favorite. Yeah, not my favorite bill. But at the same time, I love the conversation saying there's tax strategies that maybe you're not incorporating that could actually have you keep more of the money you earned.
Right.
So with that, I'm excited to have that conversation. But I've always kind of held the premise, just from my own experience, for all the decades I've been out here and working as a business owner, that the majority of my income is regular income. So I'm paying regular income tax. Yes, I've had multiple exits from businesses I've sold, and that becomes a capital gain scenario. But when you really look at the day-to-day, year to year, decade over decade work, it's regular income. And I say, by the time somebody who is a professional, a lawyer, a doctor, an accountant, a CPA, or other types of business owners or proprietors By the time you generate the revenue, pay all the income taxes, try to live some kind of a reasonable lifestyle, you can't really accumulate big, meaningful cash. So you said it. There's this sort of like the super rich. They have all kinds of things that they can do, but the people who work every day and make regular income and have to pay tax on it, it's a little bit of a different struggle.
Right.
So first of all, what is your general sense of when people come to you, who are, let's say the professional, the chiropractor, the doctor, the dentist,
Sure.
the lawyer, the architect, et cetera, et cetera. What's the general disposition you get as far as how their CPAs treat their tax returns?
I've got some good friends that are CPAs, okay? And there are good CPAs out there. There's great CPAs out there. So that being said, as my disclaimer, most of the clients that come to us say that their CPA has told them something to the effect of paying a lot of taxes is just part of making a lot of money. And I don't know if they teach that in, accounting classes or what, but you just try saying that to someone and you'll be like, wow, yeah, that's exactly what my CPA told me. And it doesn't have to be that way. So that's kind of the disposition they come in with.
So is there a natural tendency towards being conservative and don't be too aggressive or what have you? And again, as you said, it's not every CPA is this way, but there seems to be a general tone about that. So what are some of the statements that a CPA might make to a client that should kind of raise their alert a little bit and say, that isn't really a philosophy I align with? So you just said one is, paying a lot of taxes goes with the territory of making a lot of money.
Yeah. I mean, I've heard comments like, you can't put a price on compliance. You can't put a number on it. I've had comments like, well, the taxes are already a lot lower because they're capital gains instead of ordinary income. I mean, you hear comments like that, and it's not that I agree or disagree. I just think that the person earning the money should be the one making that call.
Right. So in part the question is, I want to pay the minimal amount into taxes that I can and still be in compliance with the tax code.
You have to be compliant. I mean, you have to follow the code. You have to follow the law. You need to do things properly. And, you got to think about the IRS and the tax system in the United States operates completely on a fear-based honor system for entrepreneurs, right? They don't trust the employees. That's why they take the taxes out of every single paycheck. But for an entrepreneur, if you think about it, you go and you are doing whatever your business is and you generate whatever revenue you do and you spend money along the way. And at the end of the year, you just tell the IRS, hey, I had this much money come in and I spent this much of it on things related to making it. And here's what I have left over that I'm going to pay you tax on. And what does the IRS say? Okay, I'll take your word for it. Sounds good to us. Mm-hmm. And so everybody gets so afraid of an audit. And the only thing an audit is the IRS coming in and saying, hey, Patrick, we've been taking your word for it for the last 20 years. You mind if we spot check it and just see if what you've been telling us lines up with what we find? And so if you don't have anything to hide and you've been following the rules and you haven't been doing anything wrong, then you don't have anything to worry about.
Yeah, and you said something to me earlier too, and we're going to talk about some specific strategies that maybe a lot of entrepreneurs and professionals aren't incorporating that they should maybe start to ask about.
Sure.
But you said earlier, that you give presentations, you go out and give live presentations on this, and you said one of the things you do is you put up a chunk of the tax code on the screen. So talk about that.
Yeah, I just for fun, I'll put just a little section of the tax code up on a screen and say, has anybody ever seen the tax code before? And surprisingly, almost no one's ever read any section of the tax code. And so I'll throw it up there and I'll say, can anyone point out the gray to me? And it's kind of being facetious because there's only black letters on white screen. Mm-hmm. There is no gray. And that's how I view it. So I think all these phrases that people use around being conservative or aggressive or going into the gray, I don't really buy into any of that. I just say, look, this is what the code says. We can use it or we can't. And you have to be a little creative. Sure. You have to think, how can I apply this code to my benefit? Mm-hmm. Right? It's not just, well, I read the code and nothing comes to mind. right? You have to apply a little bit of effort to think, how could I apply this part of the code?
And obviously, the amount of tax code there is beyond,
Overwhelming.
beyond overwhelming, right?
Yeah.
I mean, it's like, how can anybody read all of that code?
Right.
But there are aspects of it that, if you're an expert in the field, you should come to know and be able to apply it. One of the things, like, for example, I found interesting that you were talking about when we were just having some chit chat while these guys were setting up for us, was the idea of fitness. Like, if you, in your place of work, if you set up some type of fitness facility. So talk about that as an example.
Yeah, I mean, part of the tax code says that you can deduct the operating expenses of a gym or athletic facility. Mm-hmm. Well, my wife has a real estate company, and she works out of the house, which makes our home a premise of her business. Mm-hmm. We have a pool. That pool is an athletic facility that is made available to the employees and families of her real estate company. So why could we not deduct the operating expenses of that athletic facility that's on the premise of her business?
And it's in the code. It's pretty clear what it says. It doesn't have any exclusion saying, now, if the pool happens to be at a home residence, which also serves as an office, none of that stuff is there. So it's not like it's explicitly not allowed.
That's right.
So, and that's where you can start to find, say, wow, there's some pickups. And you might say, okay, well, that seems like maybe that's, kind of a small thing in the grand scheme of things. But you start adding a few of those up, and then you add it up year over year, and you start to see that this turns into something.
Yeah. So something came to mind that I thought was important to share. A lot of times what happens when you have a successful entrepreneur is they're used to making really good business decisions, right? And there's not any part of the tax code that says it has to be a good business decision in order to be deductible, right? So I came up here to Utah on business. What if no productive thing came out of this trip? And let's say I'm in Park City and it's a beautiful area. Do I not get to deduct it because it was a beautiful place and I stayed in a nice hotel and the trip was unproductive? But the second that you decide you're going to go to Paris on business and you might have a legitimate reason for going there, people feel like, oh, surely I can't deduct it. Because you wouldn't want to send one of your employees over to Paris just on a business exploration trip to find investment real estate or to look for financial partnerships. And so then you get hung up on, well, this wouldn't make a maybe good business decision for me to send an employee. So surely if I send myself over there, the most valuable person in the business, that, well, I can't deduct it because I like Paris. That makes absolutely no sense.
So basically what you're saying is it doesn't have to be a smart thing that you're doing in order for it to be deductible.
Right.
Yeah.
There just has to be a business purpose to it.
Yeah.
And it doesn't mean that if it's unsuccessful, I mean, okay, so you have, every entrepreneur is a salesman of some sort, right? They have to sell their business. So have they never taken someone out for business development, presentation, meal, whatever, that didn't go through, where it was unsuccessful? Does that mean you can't deduct the meal? That doesn't make sense.
No. So I guess that's one thing that maybe people think, but it's untrue.
Or like, because you enjoyed the meal, it makes it not deductible? Or because it was a nice meal, it's not deductible?
I make sure I enjoy it and then deduct it.
Yeah. Why can't you do both?
That's right. That's right. Now, there are some unique strategies that I've heard from you that I've never heard from anyone else, and especially in my varying business holdings, we develop a lot of product. A lot of it's educational in nature, and my time is spent in that product development, et cetera. So, can you talk about some of these areas that I think a lot of people probably have opportunity here for tax savings, and they haven't exploited it?
Yeah. So, well, I wouldn't call it exploited. I would say they just, for whatever reason, their advisors have completely missed it. The government incentivizes us through the tax code, right? And one of the incentives that they have is for us to create and innovate in the United States. They want entrepreneurs to innovate and create new products.
Right.
So they have a piece of the tax code that we refer to as research and development tax credits. And it is an incentive for you to go and create and develop and innovate in the United States because they want innovation here. So they give you a credit in order to incentivize you spending time and money and resources researching and developing and creating. But people will hear that and they think, oh, research and development, it must mean scientist in a lab coat,
That's what I would have thought.
pharmaceutical company. But why couldn't it be the research and development to create a new app? Why can't it be that?
Right.
You don't have to be a scientist for that. You have to know how to create an app. You have to be creative at creating a product that's useful. Why couldn't it be creating, any other type of product you could imagine, a healthcare product, a retail product? You don't just wake up and have that product. There's a whole lot of research and development that goes into creating it. And so they give you an incentive for you doing that.
Would that apply also if I get paid to go out and give speeches to speak, but maybe I only gave an hour and a half talk, but maybe I put 25 hours into research and to develop that talk so I can get paid to go out and do it?
So that brings up an important point because, it's not just as simple as saying, oh, well, I feel like I did research and development, and so therefore I'm going to go claim this credit. You actually have to do a study, and then, when we do the study, we partner with an accounting firm to certify that study and make sure that the credit is calculated properly and that the credit that you're getting is accurate so that you don't have an issue on an audit. Right? And so somebody would bring an example like that to us, and we would dig into it and dig into the study and go, okay, let's see if we can justify this.
And when you're talking about tax credit here, what it means is you're looking at a credit for your time. Obviously, if there are any materials, equipment, so on, those things that had to be purchased to do the R&D, you've already deducted those. Those are very objective. They're expenses to do product development, what have you. But now I'm saying, wow, I've got a certain amount of my time. I can look at an allocation of what that chunk of time was worth, and that further gets deducted from the net profits of the business to lower the tax burden.
Right. And your staff time. You probably have intelligent people on your team, and you're paying them, and they're putting time in researching and developing. It's not just the owner's time or not just the founder's time.
And it is development, not just research, right?
Right, it's development of the product.
So let's use...
Which could be a digital product. People think, oh, it must mean a tangible product, but it could be a digital product.
Can you give us a case study or two where you actually applied this with some clients?
Yeah, we've had several software companies. One of them, some good friends of mine, they created software that essentially is the practice management software for optometrists. And there was a lot of research and development that went into creating that software and that product. And their advisors hadn't claimed any of these credits. And so we went, we did the study, and we partnered with a specialist and got it all certified. And we're able to go back and, they got a refund of a few $100,000. It wasn't insignificant. There's been examples in healthcare and in other industries. It's real money.
So I know there was another one of these that just went away. So unless you can go back, retroactively, it goes away in the new tax code that we've had recently. So talk about that and talk about how it goes away and talk about changes in code and the considerations there.
Sure. Yeah. The IRS allows you to amend your previous 3 years returns based on the date that you filed it. Okay. So I think what you're talking about is the domestic production activities deduction, or referred to as DPAD sometimes. And that was section 199 of the tax code. And with the new tax reform that took place that became effective January 1st of 2018, they replaced section 199 with section 199A, which is a really complicated new version. I think the intention was to simplify part of the code. I don't think anything was simplified. If anything, it was made more complex. So you can go back, and just like we were talking about the government incentivizing people, what they're trying to incentivize is domestic production. Are you producing goods in the United States? Are you producing products? Are you producing something in the United States, right? And that deduction is a function of how much money you make, what your net income on the sale of that product is. But I don't understand why it gets missed so many times. Almost every client that comes in hasn't claimed it. that qualifies for it. And I just don't understand why.
And that's not insignificant. I mean, again, you start adding these things up, and it becomes some significant money.
Right. I mean, we had a manufacturing client, right? This is right down the middle of the fairway. They're manufacturing products for the oil field in this case. And the products that they're producing, they were making about $2 million of income, which translated into around $180,000 tax deduction each year. And that, depending on your tax rate, you're talking, $70,000 savings in taxes, or $70,000 you were paying extra in taxes.
That's the other way to look at it, yeah. Yeah.
So you stack that up for a few years, and I wouldn't walk past 70 grand without picking it up.
So there's changes to the tax code that happen from time to time. It looks like there's more coming down the pike right now.
Yeah.
And it's like I run businesses. I don't have time to go out and read all this. But
Right.
What is the disposition towards saying, how much responsibility should I take? How much responsibility should the CPAs be taking, et cetera? How do you see that?
I think about the responsibility like this. This isn't what you're going to want to hear, but if the tax bill that you're paying is one of your largest expenses, how many other expenses in your business that large are you neglecting?
Good point. Good point, yeah.
You're going to own it. You're going to say, this is a large expense in my life. I'm going to prioritize it. I'm not going to let it just be an afterthought. Our team, being that we're constantly looking ahead, we're constantly planning ahead, which is why we're a good complement to the CPA and their work that they do. Our team has invested a heck of a lot of time in studying the new tax code. There's a whole lot of misinformation. I mean, it was just finalized in December and made effective January 1st. And there was a House bill, and then a Senate bill, and then a joint committee, and then, and then boom, here's the new law. And then just because they signed a law, now the IRS, people don't understand this is how it works. The Congress signed a law. Now the IRS has to figure out, how do we regulate that law? What does that law actually mean? How are we going to calculate it? And then they have to issue all this guidance on, well, this is how we're going to interpret it and apply it in your business. So even now, new information is coming out from the IRS. So it's an evolving, real-time thing. But because of all the headlines going around back in December, people have a lot of misinformation. There's a lot of confusion out there. People will come and say, oh, well, I get a 20% deduction, or I get a 20% tax rate, or a 29.6% tax rate. And they're just reading headlines, and they're not studying or learning and figuring out, oh, there's actually a potential for a maximum of 20% deduction. Right. However, if you're a qualified service business like ours and you make more than $315,000 a year, oh, well, you're disqualified. Right. I don't know what we did to upset them, but
You're successful. That always upsets them.
Yeah. I mean, they carved out healthcare, legal, tax, accounting, finance. I think they just figure we don't have real businesses. Maybe we're not employing people and we're not a productive member of society, so we don't deserve the credit. I don't know what it is, but clearly the engineers and architects have better lobbyists because they got carved out, especially from qualified service businesses, and said, hey, we know that they were labeled as qualified service businesses in the definition prior, but this new thing doesn't apply to them. So
Wow.
That's where, lobbying tax legislation comes in, and maybe they have more votes. I don't know. But that's the way the chips fell. And so people don't realize all these nuances. And then even to get the 20%, it's subject to this complicated wage and asset test. So, yes, you might get a 20% deduction, It depends.
And this is where I feel the outrage, because number one, as you just described, in the tax system, success is punished, right? You're going to pay a disproportionate amount of tax or you're going to lose the ability to deduct legitimate business expenses just because you happen to be more successful at what you're doing.
Right.
Which means let's starve the people who are succeeding and let's feed the ones who aren't succeeding as much. So it's
Right.
just, you know, that's it. But and
Right. So if you're an attorney and you make 400,000 instead of 300,000, no deduction for you.
right, it makes no sense.
But if I make 300, I get a $60,000 deduction. Why? I don't know.
Yeah, it's very capricious.
Yeah.
But the other thing that is also an outrage to me, and you mentioned this earlier, and I don't think that this is right, is that I believe that the tax system is more about controlling behavior than it is about raising revenue. There's a lot of ways they can raise revenue. But through tax incentive, they can say, oh, we want people to become homeowners. Okay, we're going to put a tax incentive in there. We want people to, you know, do research and development. We'll put a tax incentive. So they literally, it's the government, like, you know, being a puppeteer saying, we're going to create markets that the free market's not going to create just by throwing tax incentives in different directions to play out our agenda.
Yeah, you can definitely make that case. Obviously, they've got to raise revenue, right? So that's definitely a component of it. But, you know, how many ways can the government incentivize us? I mean, we can throw you in jail if you do something we don't like, right? We can regulate the heck out of your industry, but to really motivate you to do something, we've got to use the tax code. I mean, jail's about getting you to not do something.
Right.
Regulation's about preventing you from doing something. So then they use the tax code to say, well, we want you to do this, so here we'll give you an incentive, a financial incentive to go, you know, produce product in the United States, or, you know, innovate and create in the United States, for example.
Yeah, and I guess, yeah, my personal orientation is the government shouldn't be in the business of trying to persuade consumer or business behavior. Let the marketplace do it. So what other cases, like, so, you know, I'm watching this, I'm a professional, I'm a business owner, and you know, I'm like, wow, I would love to, you know, sink my teeth deeper into understanding how I can save more tax dollars. Are there any other, you know, client cases, obviously not disclosing anything that you're not supposed to, but
Sure.
client cases that you can give us as examples that could stimulate our thinking around how this might apply to us?
Sure. I mean, you start with the basics, right? I'm from Texas. In Texas, if you employ your child, do you know what the minimum age to employ your own child in Texas is?
I do not.
They don't have one. Okay?
Wow.
So
my newborn can be a model for my website?
They could.
Yeah, okay.
I went to work. So I started going to our family's construction shop when I was probably 5 years old. I mean, I don't know what I was doing, maybe sweeping or, you know, something, taking out the trash, but I was helping, right? And so then they put me on payroll. And, you know, so many entrepreneurs, they have children that they could use something like that, not only as an opportunity to help their kids have money for the things their kids are going to need in life at their kids' tax rate, right? But they can use that also as a way to teach their kids about money and about taxes and about finances from an early age. You know, there's an epidemic in our country around a lack of financial education.
Right.
Where are you supposed to get financial education? You're not getting it in high school. You're not getting it in college. I don't even care if you have a finance degree. You're not really getting it. You could get masters in finance and still not have the real world financial knowledge you need.
Right.
So then you get out into the workplace, and let's say you're successful and you go out on your own, and then you become a successful business owner. Now you have more money, more dollars moving around. You still don't have the education to know what to do with it. Let's say you become a really successful entrepreneur and you decide, I know, I'm going to run for government. I'm going to run for office. But you still don't have financial education, and now you're writing the laws. So, like, where are they getting financial education? And I think it really starts at home, and I think entrepreneurs have a huge opportunity to raise their children with that education. You know, and the first step is put your kids on payroll. Put them to work. Let them, you know, reduce your taxes and have them pay some at their rate. And their rate should be a lot less than your rate, right? So it's things like that. I mean, we were talking earlier about the home office deduction and how people feel like, oh, that's a red flag, I don't want to claim it. Why would the IRS give you 4 different ways of calculating it if they don't want you to have it? clearly they're okay with you claiming a home office deduction. Now, if you have a home office and you try to claim your entire house and you're only using one room, you're going to have an issue.
Right.
But as long as you do it according to one of those 4 methods, and so there's just a lot of basic little things like that people are stepping over.
And incidentally, you can still have another office, but keep a home office also, a commercial
Right.
office, keep a home office and still get that deduction.
Yeah, I mean, okay, just because I do some work at the office, you think I don't work at home?
Right.
I probably do as much work at home as I do at the office.
Right.
So why would I not claim that? And I think it's really because most entrepreneurs are good people. And we have a conscience and we think, I don't want to try to take advantage of the system. But the reality is you're robbing your wife, your spouse, your children, your employees. You're robbing them by not, standing up and going, I'm not taking advantage of anyone. I didn't make these rules. I didn't write these laws. I didn't write the code, but I'm going to use it.
Right.
I'm going to use it to the fullest extent to benefit me, myself, my family, my business, my employees. Right? How much impact can you make in your community if you get some of these resources coming back your way?
Right.
Right? So it just starts with these basic things like what we're talking about that get missed. I mean, the tax code says that you can rent out your residence for 14 days a year and you don't have to claim it as income. Okay? But this is where creativity comes in. Why not have your business rent your home as a venue? Because if your business can go rent a restaurant as a venue, you're going to claim that as a deductible expense because you had a presentation or seminar at a restaurant. But if you decide to do the same thing at your house, all of a sudden you feel like you can't look up what the daily rental rate would be if you put your house on Airbnb and you can't rent it to your business or your wife's business.
Interesting.
Come on.
Yeah. So, and that's another thing that I'm not aware of, or a lot of people aren't aware of, is
Yeah.
that I could have my own company rent my own house for 14 days, and it doesn't add to my income.
Yeah, and so if I get income for renting out my house to strangers, it's okay. But if I rent it out to my wife's business to have client appreciation events, that's not okay. And I think it's because we're just good people and we're trying to, not take advantage of the system. But in doing so, we're actually taking advantage of the people that we care about the most, family, our friends, our employees, right? And so which one do you want to take advantage of, right?
Any other things like that you think are worth mentioning, or any other, or an actual case of saying, here's a client showed up, this is what their circumstance was, and here's how we were able to help them?
Yeah. I mean, the government allows you to deduct now with the new tax law up to 60% of your income for charitable deductions. And what a lot of people don't realize is that you can create a charitable entity or charitable trust where you can donate that money. You can still control it and invest it and work with it. You don't have to give it all away today in the form of cash to a charity, right? And so a lot of people have good hearts, like we were talking about, and they want to help their community. They want to make an impact in the world. And there's very efficient tools with lots of tax incentives involved, right? That it says, hey, if this is a mission that's important to you, let's take advantage of the tax laws around charitable planning, right? So that we can maximize your impact. And we've had people come in and, they save a lot of money on taxes by doing it, but they're also creating a lot of positive impact. Depending on your income, I mean, you could be saving hundreds of thousands or millions of dollars on taxes, right?
And you can still enjoy the benefits of the activities of that trust.
Right. There's a whole world of planning there. The government creates tax incentives for different forms of real estate, affordable housing, preserving historic properties, conserving land from development. There's all kinds of tax incentives out there, and it really just depends on which one applies to you. There's probably 70 different things that we help people with. And so it really is client specific, which one makes the most sense to them. You know, a lot of business owners, if you and I are partners, we might have life insurance on each other in case one of us dies, right, to buy the other one out. Well, you can take that life insurance and put it in a trust and get 70% deduction on the premiums. You know, you might go, okay, well, that's just trying to sell life insurance. Is it? If you can get that deduction on the premiums, you're more likely to get the life insurance.
Right.
If you get the life insurance and something happens, God forbid, what probability does that give your business of staying alive and all the people that are depending on it for a paycheck and their livelihood? So how many families is that affecting, right? So people think about, okay, how do I defer taxes? Maybe I'm making a lot of money and I'd rather pay it later. Well, there's a whole array of defer options, you know, or options to defer. And so, you know, we've gotten people to where they've been able to defer $600,000 of income per year.
Wow.
That's significant. You know, and if you and your wife are working together and you both do it for yourselves, that'd be $1 million too. That's a lot of tax deferral that you get to invest while you're not paying the taxes. Yeah, you're gonna have to pay it later, and there's potentially a lot of issues around that. And
Can that be reinvested back in the business?
Well, you know, you can't reinvest it in your business, but you could invest it in somebody else's business or some real estate partnerships. Right?
Yep.
So none of these strategies are like a one size fits all. Right? It's about the right combination, the right blend. You know, sometimes we find entrepreneurs have risk in their business that they aren't insuring. You know, and we've worked with folks that, you know, they have legitimate risk, that we've had, you know, feasibility studies and actuarial studies to justify and certify the risk and put a premium on it. And they've created their own insurance company to insure that risk. Well, insurance companies have a different set of tax laws than regular businesses because they don't have to pay tax on all of the income because they have to reserve it for the event of the liability. Well, if you control the insurance company, then you can invest it. Right? I mean, I think, you know, they talk about Warren Buffett's favorite investment being buying insurance companies. So he has all these huge reserve to invest. Right? So why not bring that? It's not just for the Warren Buffetts of the world. Why not bring that and apply it in your business? You know, it's about finding what fits in your life. Right? What causes the least amount of disruption in your life? What level of complexity can you live with?
So now I've watched this. Or stop the video. What should be the first steps I take?
You know, I think you start by seeking out good advice. Unfortunately, you know, the financial services industry is full of a lot of people that have no business being in it to begin with. Most people that call themselves advisors probably can't even read a P&L. They don't even understand business. So they don't have any place advising a successful entrepreneur. So it's hard. It's hard to find people. I think you just have to start asking the people that are closest to you, that you look up to, that you respect, that are successful, and you know, make it a priority to get out there and start looking for the help. Start asking for the help. It is hard to find. I mean, the places that are easy to find are the big four accounting firms, right? But they're working for the publicly traded large corporations. They're not helping the successful plumber in Utah, you know? So who's going to help him? So the firms that usually end up providing that help are your regional or smaller kind of boutique firms. And so, you know, you just got to stop and go, hey, do I think the advisors that I have helping me today are the advisors that I need now? You know, it might have been a good decision to hire them when you did, because they might have been a good fit for where you used to be. But now you've grown, you've expanded, and you might have outgrown the people that are trying to help you. You know, so I do think it's an issue. You know, people don't know where to start. They don't know where to go. There's a lack of information. Just think if everybody started claiming their home office deduction, and that put a few $1,000s back in everybody's pocket. I mean, you know, it's a few $1,000s is a start. You know, now depending on your income and where you are, you might say, oh, that's insignificant. But, you know, when you're talking about where do you get started, I mean, start with the basic things you can do at home. We already talked about them, you know, Rent your house out for events related to your business. Get your kids on payroll. Start teaching them about money and taxes, and claim the deductions that the IRS puts 4 methods for you to calculate, like your home office.
Right.
There's simple things like that people just aren't claiming out of fear. But you have to recognize our tax system in the United States is, like we discussed earlier, it's a fear-based honor system. You're afraid that if you take the approach of how do I calculate the least possible amount of tax that I legally am required that I have to pay, if you take that approach, they instill fear that, I don't know, something horrible is going to happen to you, and your imagination is way worse than any reality that could happen, right? And so it's tempting to just think, well, I'll just, pay the maximum amount of taxes I can possibly imagine paying. Surely I won't have a problem then. But you do have a problem. The problem is you're stealing from your family.
Yeah.
So I think it starts with prioritizing it. You asked, hey, how much of this is my responsibility? We talked about the size of the expense, and you wouldn't neglect that size of expense in any other area of your business.
Right.
You're not going to have an employee that you pay that much that you decide, I'm not going to manage them. Forget reporting to me. Let's not meet. Let's not talk about it.
Well, I think there's certainly a lot to consider there. And as you said, it's for many of us the biggest expense we have. And it would make sense to demystify it and dig into it. And I think in the end, I'm ultimately responsible for the taxes I pay. I have to figure out who my team is, what positions I'm going to take on it, et cetera. And I think I probably pay for any amount of ignorance I have. It's going to cost me.
Yeah, it's costing you.
Yeah, no doubt.
Because doing nothing is a choice.
Yeah,
and it's a costly choice.
Yeah.
So.
Well, Jeff, thanks so much for coming and sharing this wisdom, and also for communicating, on this subject that a lot of people try to avoid, but avoidance is, not a good strategy for when it comes to tax planning. So thanks
agree.
for coming and sharing this.
I hope this helps people start to take ownership and responsibility and do something about it in their lives.
Terrific. Thanks so much.
Yeah, thank you.